Hi YouTube, it's Janelle here. In this video, I'm going to be sharing what the difference is between mutual funds, index funds, and ETFs or exchange traded funds. A lot of people have been asking me questions about these to my inbox and also in the comments. So I figured I would just put a video out to explain the simple differences between them, especially since I already posted a video about the difference between stocks and bonds, which you should check out here if you haven't seen it already. I'm going to jump into that video in just a second, but first I want to remind everybody to go over to my social media and check my Instagram out, check out my Facebook. Go like, add, follow, all that good stuff. Show me some love on there. I try to post as often as I can, so definitely love interacting with people from YouTube on there as well. And then also that I have a Patreon page, which is linked in the description box below. You can go click on that and go over there and choose to give a gift to help me continue to put content right here on this channel, which I love. So definitely go check those things out. But yeah, I'm going to go ahead and jump into talking about the difference between mutual funds, index funds, and ETFs. For me, this was something that kind of took a little bit of time for me to understand, because it's not really that difficult to understand. It's kind of basic when somebody explains it to you, but it takes a while for you to figure it out if you're doing your own kind of research, if you don't have like an advisor or like a mentor to just kind of explain it to you in plain English. So yeah, once I kind of got a grasp of everything, the difference between all these things, I was able to really explain it better. So now I'm kind of like, all right, let me put this on my channel for people who have been asking me about it. The main thing you need to know is that way back when, when only old men were, using stocks and investing and selling and trading stocks, on Wall Street and stuff like that, people knew that it was important to diversify, like not put all your eggs in one basket. But it was just very difficult to be able to do that, because you either needed a lot of time or a lot of money to pay someone else to do it, so you wouldn't have to take the time to do it. Either way, it was something that required a lot of resources, and there wasn't really a quick and easy way that was a sure shot way and guaranteed you, a decent amount of growth in the stock market, until mutual funds came out. And mutual funds basically make a basket for you and put a bunch of different, assets in there, different stocks, different bonds, and make it into like a group of investments, so that you're not putting all your eggs in one basket, right? And so mutual funds got really, really, really popular because it was like, oh, I'm gonna have a little bit of everything in there, and I don't have to start picking and researching and choosing my stocks myself. That's awesome. I'm just gonna pay someone else to do it. But the thing is, paying someone else to do it got really, really expensive, because since that was a popular option, a lot of mutual funds were run and managed by a fund manager who was charging like 1%, sometimes 2% of the return, which means that every $100 that you make, you have to give $1 or $2 away to the fund manager. Now that doesn't seem like a lot when you think like, oh, okay, well, I still get to keep $99 or $98 out of the amount I made. But over time, and especially when you're making lots of money, it does add up to a lot of money. It's a big piece of your pie that you're working so hard to kind of grow, and then this person gets to just take it. And so a lot of times what was happening was that these managers were trying to watch the market and like trying to beat the average performance of the market. And some would get it right, some wouldn't. Most of them wouldn't get it right. So you're paying all this money as like, you're not even sure if you're, getting something that's worth the money that you're paying. So basically, mutual funds was like the first way for people to diversify, which was a really good opportunity. But then index funds came out. Index funds are a type of mutual fund. So index means that it's not just a fund manager who's coming in and picking stocks, but it's actually going to follow a specific category or a specific bracket of stocks or bonds or whatever, right? Whatever assets you're going to put in there. So for example, the category could be like the 500 companies that have averaged the best returns in the past 10 years. So you would type into a formula, would come up into the computer to figure out who those top companies are. And they would crunch the numbers, and the computer would spit out to you, okay, here are those companies. These are the 100 companies that have done the best on average in the past 10 years. And then all you have to do is put your money in the account, and the computer is going to divvy it up and make sure that it's always spread out evenly throughout those 100 companies, and kind of keep an eye on that. You're guaranteed to get the average of all those 100 companies in that market, in that little, kind of entire market that you created. So when you have an index, you basically say, okay, I'm going to follow this specific category of these specific companies that follow this specific profile, and I'm going to be guaranteed to make the average of all the companies in that, group. So once index funds came into the game, it was like, mutual funds, buy, like, you out the door. Nobody's gonna pay a fund manager all this money, like 1 to 2% of what you're making, if you can get an index fund that's gonna guarantee you the average performance of all these companies for way less. Okay, so now you have mutual fund is kind of like the big umbrella. Under that, you have index fund, which kind of changed the game and kicked that fund manager out of the equation and saved people a lot of money. And then under index funds, you have ETFs, which are exchange traded funds. You can only trade once a day when you have a mutual fund or an index fund, because of the fact that there is a company that is basically handling the fund for you. And that company is going to make the trade for you. So you are only allowed to make a trade once each day, and you have to wait for, the closing price or whatever. But with exchange traded funds, they're not managed by the company that's buying and selling the fund. You have more control to exchange and trade the fund yourself. So basically, it is sold and bought on the exchange, just like, like the New York Stock Exchange, just like individual stocks are. So basically, when you notice that a fund is doing really well, or the price is going up and you want to buy more, or you can buy more at any time, or if you notice that the price dropped a lot and you or you notice that the price is really, really high compared to when you bought it and the price was lower, so you made a lot of profits that you want to sell, you can sell at any point throughout the day. You can exchange it yourself. You just need to have a brokerage account so that you can go log in and buy and sell. But you don't need to leave it up to the company to make decisions of with that fund, or to sell the fund for you. You can trade it yourself. So because of that, and because you could trade it at any time throughout the day, you don't have to wait till the end of the day. You have a lot more flexibility. You have a lot more control. There is a company that does this all for free without charging anything, which is called Wise Banyan, and you guys should definitely check it out. I am not sponsored by them. I don't work for them. I don't get any money from saying this, but I do think that everybody should always know what the free opportunities are, because if you don't have a lot of money, if you don't have a lot to work with, you're very you don't have a lot of resources, you want to try to always go for the free stuff. So especially if you're a student, I always advocate for trying to, look for free stuff if you're a student. And, and if you're low income, or just trying to kind of, do stuff with your money, but you want to really maximize it, you also might want to check out Wise Banyan, because you don't get charged fees the way that you do get charged with like Wealth Farm Betterment. And they have a lot of similar offers and services. So yeah, that's pretty much what I have for you guys in this video. I definitely encourage everybody to read up more on this. My explanation is very basic, is not very thorough. But yeah, I just pretty much hope that people kind of get a sense for, why the different types of investments exist, and all these different names can be confusing. So I try to just make it as simple as possible. But yeah, if you really like this video, go ahead and give it a thumbs up. If you have questions about anything that I said in here, or you want to add anything that you think I didn't cover, you can put it in the comment section below. You can always write to me as well privately at missbehelpful@gmail.com if you have something that specifically that you want me to talk about, or you want me to answer about your specific situation. If you have not yet subscribed to the channel, go ahead and subscribe right now. Click that red subscribe button and join me on my financial journey. I post videos every week right here on my channel. That's all I have. Till next time, peace.